Welcome once again to the Ahern video podcast. Today we're going to go to part 2 of selling your business. Last week we discussed establishing a market value for your business by utilizing someone that specializes in transportation. Assuming that analysis reached your expectations or strike point, then you had to actually go through a process of physically and mentally letting go, which is a very difficult process. I said last week that selling a company is like planning your own funeral, so it's a very emotional process. So assuming that what the market is willing to pay for your company is acceptable to you, assuming that you have something else to do with your life going forward, then you need to assemble a team. And you need to know what approach you can take and what information you can release and what information you shouldn't release. And let's start with a process. You've got 3 types of variables that you can use. If you're a small company, you can utilize a business broker. You can use an M&A advisory service, or you can go use your local attorney. And if he has transportation experience, he may be able to bring in a qualified buyer. But you need to have someone that has a lot of transportation experience because, number one, just because a buyer's big doesn't mean that they're going to buy your company. Just because they're large doesn't mean they're financially solvent. So you have to have a mechanism, and that's what your advisor provides to you, that says they have the financial wherewithal to acquire your company, assuming that you meet the certain strike points. The more information you know about the buyer, the better prepared you're going to be. Now, if you use a business broker, that business broker is in the middle. So you have the buyer here, you have the business broker here, and then you have yourself here, and they, in many cases, try to control the situation. Does that work to your benefit? I personally don't think so, probably because I'm in an advisory service, but let's put it this way. You know more about your business than anybody else. The buyer knows what he or she wants. The more that you can interact, the better opportunity you have to see if you have the same moral values, the same ethical values, because it never gets down to just price. In the process, if you're a trucking company, we'll start with a trucking company, then we'll talk about a freight brokerage. There's certain specific information you have to have readily available. You have to have the financial statements for at least the last 2 years, balance sheet, and a profit and loss statement. If you're on a cash basis, have your accountant convert you to an accrual basis. You want to show your projections through the interim part of the year. You want to show your add backs, which I've discussed in the first series. If you've got an equipment list, you want to show what the orderly liquidation values are and the fair market values are. You don't go out and get an appraisal and spend a lot of money if you're a small company. Just go to your truck dealer and say, look, I'm doing my estate planning and I need values for the estate on orderly liquidation or fair market value. Don't try and do it yourself. Insurance value has no bearing on what a buyer is going to pay for your business. And then you have to look at your business. And I always say that you should have a review of your business before you get ready to go to market, because even if you're a $5 or $10 million trucking company, you're probably going to incur at least $25,000 in legal and accounting expenses to go through the due diligence process. It could be more if you don't know how to control those advisors' costs. And in our services, that's what we help you with. We have a network of transportation attorneys and accountants that you can work with. We have some transportation attorneys that are CPAs, so you get a combination of both, the best of both worlds. But the point is, you need to be able to provide a certain amount of information. You need, if you're a trucking company, operation and statistical data. You need to be able to show your revenue per mile, your revenue for all miles, your empty mile. So you also have to make sure that you don't have more than 20% of your revenue with any one customer. Many small companies do. You also have to make sure that you don't have more than 10 to 15% of your business with freight brokers, because that means that you don't control your business. Now, it doesn't mean you can't sell your business, but it means that, for example, if 50% of your business is brokered business, you're not going to get the same rate of return, because strategic buyers are looking for people, they're looking for drivers, and they're looking for additional customers. They want to build on that customer base. If you don't have those 3 components, the less of those components as you have, the less likelihood you're going to get of getting the maximum dollar. They're going to look at your empty mile ratio. If you've got maintenance, they want to look at your maintenance costs. You want to try and break it down to a maintenance cost per mile. because a strategic buyer wants to come in and they don't want to waste a lot of time. So they want to look at your maintenance costs, they want to look at your average revenue per mile. I think it's the American Transportation Research Association. You can download their average costing for a trucking company, and you can see how that compares. But you have to have a lot of information prepared. And then you have to know what to release, when to release it, and how long your letter of intent should be outstanding. So next week what we're going to talk about is the letter of intent, the process of going through the negotiation process, when to bring your attorney, when to bring in your accountant, when not to bring in your attorney, when not to bring in your accountant. Until next time, thanks for attending the podcast.